Hello YouTube, welcome back. Thanks for joining us again on the channel. We're going to spend today running through an example model. It's actually just a simple P&L budget variance model. And I think the main things we're going to be focusing on today are just the importance of the process of budget variance. So, it's a very basic model, but the concepts and the process flows that we would go through in this are applicable across different entities. You could do it for your own personal life, but obviously it's something that we would do, or in this case we're doing it for a business. It's just an example model, just some made up numbers, but it's illustrative. All right, so if we jump straight into it, this is the end result. Now, this is the last page that we will get to as part of this overview, but we've got some pre-populated numbers. But the idea here is we're looking at the end result and what is commonly done as part of the process of running a budget variance analysis. So, as you can see, it's the profit and loss statement. I can see my revenues, cost of sales, margins, so on. And an important part of this process is looking through this set of statements and going, okay, we've set a budget. Often you'll see things set up in a latest month, a year to date, full year, and there are other variations, like there's other people that look at, this year versus last year, this year versus last year as a percentage. They might look at quarterly variance. So there's a lot of different ways that people cut it. And we can explore a few in other instances, but for this one, we'll look at our kind of standard way of approaching things. So as you can see, the way we generally pull this open or look at this is we generally open this up and go, okay, at the end of the month, once the financials are closed, once your books are closed, we will pull open your actuals. We will look at the actuals for the month compared to budget, assess the variances, and this is where we can have placeholders on the right. A lot of people, put commentary on the right, put spacing on the right just for free-form commentary, just to explain some of the variances, or, as a placeholder or a note for next year's budget variance or budgeting process, so that things that weren't captured or weren't captured accurately are captured accurately in next year's process. So, people love to say that forecasts are never accurate. Well, yeah, that's, forecasts are wrong the very next day. But what the whole point of the process is to develop the financial discipline to look at your forecasts, have a budget, bring in your actuals, and on a consistent basis, review your actuals against what you budgeted, and ensure that if you start seeing large deviations, it gives you time to start going, okay, well, is this something I need to do right now to address this? If revenues are a lot lower than they were in your original budget, which in 2022, towards the end of this kind of year with a lot of volatility, it does seem like it is something that is going to be prevalent in the market. So, this is the process to start going through. Okay, it's time to revisit the budget, or look at the budget, look at a forecast. Where did we say we'd be? Are we there? Are we close? Are we really high? Are we above? In this example, are we below on revenue against budget? Is our projected higher than our budget? Well, this is where you start asking questions of your forecast, asking questions of your actuals. So, does the numbers make sense? For example, if we expand our OPEX a little, are there any big ticket items that are quite far off? In these ones, the numbers are relatively small, so there's nothing particularly exciting there. But yeah, we're, for example, down on revenue. Okay, but we're also equally down on our margins. So, okay, at least from a margin perspective, we're actually managing. So these are the things that you're sort of looking into when you're running your income statement variance analysis or your P&L budget variance analysis. And so here's a simple model. I'll just run through this model and how it works. So for example, we have a starting time series. We allocate the first financial year. This one's a bit older, but obviously we can change the financial date to start in 2023. All the references will be 2023. But if we just change it back to our 2022 time frame, and then we have a look. Okay, so we've got some instructions here about the setup. As well as the instructions around the monthly update. So, budgets is not useful if you're not actively tracking against it. So that's why it's important to, one, set the budget up, and two, do your tracking. So bringing in the latest actuals, revisiting the P&L forecast, so revisiting your revenues, your expenses, and ensuring that, they still make sense, updating that, and then checking against your budget variance. So if we run through the process, we've got our instructions here. We've set up our starting periods. We're going to look at the historical period. So these are numbers, if you have systems that can bring the data in, obviously that makes processes a lot simpler or faster. But without that, you can still key data in. So, if you can print out the Xero file, start copy pasting, and start bringing in some of your categories. So I like to, when I bring in categories, to see things in broad categorizations that make sense, ensuring that my so my revenue, my cost of sales are allocated correctly. This is something I often find when I look at files and look at transactions. I often find that things aren't allocated correctly, which distorts margins. And margins is another topic that we'll pick up in a separate video. But getting your chart of accounts right for your business is actually important. So it's not something you Xero, or if you use Xero or MyOb, they usually provide a good starting point, but it is definitely worth spending a bit of time as a financial as a piece of your financial governance to actually run through your chart of accounts. Make sure they make sense for your business. So what we've got here is a set of historical data. The way the model flows is historical data gets brought in, whether you can import it or you can copy paste it in. And then in here we have a budget set up already. The general process is, we would run a forecast and store the budget. But in this example, we already have a budget set up. So here's the budget. It's just left here. But if you read the instructions, we do go through, okay, you should start with historical so you can set up the chart of accounts. You then create your budget for the next year, and we can run a whole cycle, run a separate video about, the ideas and thinking behind budgeting processes. But let's just say, it's a relatively, simple business that you can forecast out. You're just keying in numbers. You can use last year as a reference, or you can just use your, your thoughts about what you want to achieve this year. But for the purpose of this video, we've got a budget already stored. And then what we have is then a set of forecast numbers. So what we'll have is, just so in this particular version, we just have spacing here to insert your forecast. So if forecasts change, we will then change these assumptions, and then that will have an impact on what your variances will look like. So for example, in this case, we might go to forecast and say, all right, look, we know that historically here are the numbers, but we see a lull in these next few periods. So maybe what we'll do is we'll just bring down the revenue forecast, let's say 7,000, and then we can bring up the and then we can, these seem okay, but we know that during the December and January period, and maybe we just didn't, cater for it properly. We didn't think about that December and January is a quiet period. So whatever reason, just thinking about your forecast, understanding what that looks like, and then we can quickly jump back over here. Oh, okay, well, previously for a full year, we were up on our variances. Cost of sales, ideally we should also change that. So let's also bring that down as well. So let's just go, in these periods, we're now down to 5,000. Generally you might want something like a percentage of revenue, but we're just trying to keep this simple so that people can see or just key numbers and see what that gets to. Nothing stopping you from having a separate model on the side that calculates your numbers that can be brought in, or you can build the calculations in this model. We can see that in spite of that, margins are maintained. And then that's okay. Or what we can also look at is, well, what if the case is that they don't get maintained and we actually are still at the 6,000 mark? Well, then our variance shows that we're now carrying for a full year a negative gross margin, with our projected margins being lower than what the current actuals are, which may or may not happen. And if anything like that starts to trigger, okay, well, that means our EBITDA is now going to be lower than we expected. In this circumstance, it's not leaving a lot of margin. Maybe it's an early sign to start going, okay, well, we need to start thinking about, well, we budgeted for a certain amount of revenue and margin, we're not getting there, and analyze the business. Is that a short-term thing? Is that just purely a short-term issue? It's a good instance to start talking to your customers, your suppliers, and just getting a sense of where they are feeling, especially understanding your customers. A business starts with the revenue, so you want to understand from a revenue perspective, are we still there? Are we still going to hit the numbers? And if you're not, well, it's probably a time to start making, unfortunately, tough decisions. So, whether that's reducing hours where you can, whether that's, removing some of the subscriptions that might not be adding value like you thought they were. It's just a prompter to start thinking about, revisiting some costs. And what we then do at the end of the month is we would roll the latest set of numbers to, say, October. Our historicals will now allow us to bring in data, and you'll also see if we jump on the forecast side, there's no further historicals because we're reading the historicals off this section. So, for example, if I just drag the numbers across just for simplicity's sake, we can at least get to see some numbers coming through. You're just seeing some errors just raised by Medano. You can probably ignore that. For those familiar, it's just because I'm copying to the right. Okay, so then what we can do is we can revisit the budget variance. We'll see that our model has moved over to October. We're now looking at the variances in the period. Of course, because all I did was drag the numbers across, the margins will have stayed the same. Year-to-date figures look the same. But then, our forecasts are now based on actuals plus our revised forecast. And the revenue is actually higher because from an actuals perspective, we said we were going to do less, but we've now done more. So anyway, this is a simple budget variance type exercise. It's good practice to do this for any business, large or small. I know large businesses, this is a very detailed process that occurs every year. So, take it from the corporates. They do it this way. They enact policy to do this. So why not, as a smaller business, also think about this process? And it helps to give your business some parameters, some direction to follow. You don't have to hit the numbers. It'd be great if you can, but ideally it allows you a process to assess your business on an ongoing basis. Hopefully this video has helped. The model's available on our website. Jump on and I'd appreciate if you can give us a like or a subscribe, and we'll keep creating more of this content. Thanks for joining us.